Well, greetings, my beloved clients and friends. So, just want to do our weekly update. And so this was a short week. Labor Day was Monday, so we had a 4-day week. And seems like what we had talked about the week before came to pass, which was traders got back off of vacation and they saw that some really good companies were really cheap. And we had a really nice bounce from the previous 3 weeks. And so there are a couple that we bought, a couple that we were looking at that we didn't buy. I don't know if I might have missed the bottom on those two, but we're still looking at them. So, and I think the narrative is changing a tiny bit in that inflation doesn't seem to be the bigger fear of the two. I think recession is becoming the bigger fear. So it's like, you're driving down a icy road and your tail's just going out of control. We had COVID hit and slammed, shut down the economy, and so the tail went way out. And then the central banks poured massive amounts of stimulus, and the tail went the other way. And then because they were pumping money too fast, the tail went the other way. We got inflation, and so then they started raising rates aggressively. And I think the next swing is recession, and so we got to slow down these wild swings. It's like, does the Fed act more aggressive or not aggressive enough? Do they oversteer or understeer? Right? There's a method to it. And so hopefully they get it right. I think what the speech Powell made was the right one, but I think you should keep an eye on recession as well. So globally, on a relative basis, the US is in pretty good shape compared to Europe and Asia. Now, they're not in great shape. US isn't in great shape, but compared to what bad shape Europe's in and Asia, particularly China, of the three, U.S. is in the better shape. So I think it's going to be a safe haven, both large cap U.S. stocks and U.S. bonds, including government bonds. So rates should be wanting to go up as aggressively as Powell is raising rates, but they might not, because money's coming in from around the world, because it's the safer place to be. I wouldn't want to put my money in euro bonds or rupees or rubles or the yuan. So I think that's going to help the U.S. economy. And like I said, some really good companies are cheap. We told you last week that we bought Salesforce, and this week we bought Comcast. So I'll talk a little bit about that. And so Comcast, they're the big cable company, but cable isn't their only business. But cable is a very good and stable and high cash flow business. And I hope I could do this video because it might get a little windy, so I'm a little worried we might get too much wind noise, but I'll do my best. So when a company decides to lay cable in a new neighborhood, they pretty much have a monopoly, because not 3 companies are going to go in and lay cable usually. So if you decide you want cable for TV and internet and phone and stuff like that, you go with the one company. So it's a pretty stable monopoly. In recent development, some people are cutting cable, especially for phone. For phone, for one, and for TV, they're just doing streaming. And now there's wireless internet options. So there's some deterioration of their core business, but they're reacting well. They bought NBC Universal a few years back, so Comcast owns NBC, Universal, Telemundo, DreamWorks, among some other companies. So they create content Universal Studios, theme parks are owned by them. Universal Pictures. So they have a big content library. They own Peacock, was a streaming service. But I don't know about Peacock. They have to get to critical mass because their big competitors are one, Netflix, and two, Disney. And they're kind of a distant third. So they're not in a great position there. So because of the long-term deterioration of their core business, they're not the type of company that I would buy and say, I'm just going to hold it for the next 5, 10, 20 years. But the reason we bought them, it's more of a tactical investment. They're extremely cheap right now on a relative basis. And so their price to earning ratio is in the 11s. And that's the lowest it's been for like 20 years. In the bottom of COVID in March of 2020, they got down to about 12 times earnings for a minute, and then they bounced back. In 2009, October actually, was the lowest they got to about 12 times earnings. So we could pick them up at 11 times earnings. That's territory that they've not been in for probably 20 years. So it's very attractive on earnings basis. Like I said, they are a cash generator. They're about 6 times operating cash flow and 11 times free cash flow. So really, you're getting really good cash flow. They're a dividend payer, and probably one of the most consistent and successful indicators that we've had, that we have used to help identify good companies that we've had success with in our office, was the dividend yield. Looking at the dividend yield for a particular company relative to their historical dividend yield. And when the dividend yield is high, it's an indicator that it's cheap. And I might have explained this before, but I'll go into it briefly. So let's say a company pays a $3 annual dividend, and the stock is trading at $100 a share. So that would be a 3% dividend yield. Now, let's say the stock drops to $50 a share, but they're still paying the $3 annual dividend. Now it's a 6% yield, right? And let's say the stock runs up to $200 a share, but it's still paying a $3 dividend, then it's a 1.5% dividend yield. So when you see the dividend yield higher than it's been historically, it's saying two things. One, for some reason the market doesn't like that company, but senior management is still okay with it. They haven't lowered the dividend out of fears. So first we want to look at it to see if we have a good high quality company. Then we want to see if it has a attractive dividend yield relative to where it's been. And the type of company that we're looking for is one that's paid a dividend for a long time. It pays it consistently every quarter and tends to raise it every year. Comcast checks all those boxes. And so they recently raised their dividend by close to 10%. So and one other thing, that the dividend payout ratio, how much of their earnings go to dividends, has remained consistent. About 30% of earnings go to pay dividends. So, I mean, if you saw a company that was 30% of their earnings were going to dividends, now it's 50%, now it's 80%. That means they're continuing to raise their dividend while not earning more, and that's a dangerous position. But Comcast has raised their dividend and maintained that dividend payout ratio consistently. So the dividend increases have been in line with earnings increases, which we like to see. Okay, so that was the kind of dividend we like to see, and it was higher than it's ever been by quite a bit. So yeah, the dividend popped over 3%, which it hadn't been since they started paying a dividend in 2008. So to us, that would signal that the senior management is very comfortable paying that dividend because they don't expect to lower that dividend. That's a really bad thing for a U.S. company to do, in particular, to lower their dividend. So when they raise their dividend, it's like a signal saying, we feel very comfortable that for the foreseeable future, we could continue to pay this dividend. And so the price of the stock went down, but the confidence from the management did not. That would be a time that would signal that the company might be cheap. Okay, so that's why we bought Comcast. And like I said, it's not a long-term hold. We might, I think we bought it around $34, $35 a share. I believe within the next 2 years it should get close to $50 a share. So that's a 40% increase. So if that happens within 2 years, that's about a 20% annualized return plus the 3% dividend. So like a 23% annualized return. If it happens sooner, that's a better return. But I don't suspect that we'll be in it for more than 2 to 3 years. But I believe we could get high teens, low 20s returns on that position with pretty low risk. I mean, I don't see it going meaningfully lower than where we bought it. I mean, it could dip a little bit lower, but I don't see it going meaningfully lower. So I think we have good downside protection and good upside potential with a company that has great cash flow, a great business, and a near monopoly on this that broadband. So that's why we bought it. A couple others that we were looking at that we haven't bought yet, and we might have missed the bottom on them, was Adobe. I like that one a lot, and Shopify. Shopify, I'm just worried that there's some downside if things could go bad. But it also looked cheap. It looked cheap on a relative basis, but not absolutely. Adobe looks pretty good. I'm kind of kicking myself for not buying that one. But I told another client, I was like, well, I'd rather not buy it and wish I did than buy it and wish I didn't. So, you know, we're not losing money on cash. So that's where we are. One other thing about inflation, just to wrap up. So one thing that has kept inflation down over the last 20 years or more is demographics. There's an aging of the population. And as the population ages, older people tend to use credit less, and they tend to have more to invest. Okay, so they're not a demander of credit, they're a supplier of credit. So the Fed could throw money into the economy, and these people will buy it up, right? So why are rates so low? It's because there's all these older people with money, and they're looking for rates. If rates went to 5% on a government bond, it wouldn't stay long, because all these old people are like, that's a good rate, I'm going to put my money into 5% government bonds, because they haven't seen that in 20 years, right? And so if rates were at 5, they wouldn't stay long, they'd go down. So, and that demographic trend is continuing. So I think that is going to keep rates down. So even though Powell can raise the short-term rates up, I don't really see mortgages going up over 7. Maybe, but I kind of doubt it. I mean, in the 6s, they really put a brake on the housing. So even if Powell raises the short-term rate another 1 to 1.5%, I don't think long-term mortgages are going to hit 7. Yeah, so just a comment on rates, just a short video to update you on what we did this week and what we see out there. Hope you guys have a great weekend.